Welcome to my Accounting 1110 review for final. It's the second to the last one. I can hear the cheering around the valley. The topic that we want to cover in this review is contingencies. I have a goal. Are you surprised? I started to write that my goal was to learn the accounting for contingencies. But since this is a review for final, we better be actually only reviewing accounting for contingencies. And in this example, I am going to use warranties as an example because it fits in nicely with the definition of a contingency. So let's start with that. In our definition of a contingent liability, it is something that you may or may not owe as of the balance sheet date. Whenever you talk about contingencies, there's certain terminology you must be aware of. And this terminology relates to the likelihood that you will end up owing something. If the likelihood that you will end up owing something is remote, what does that mean? And it means there's very little likelihood that you're going to owe somebody something. As a result of the contingency we're looking at, the second definition is reasonably possible. It's you might owe somebody something. You might owe somebody something, but it's a maybe. Not a likely. It's more than a remote chance, but certainly not probable. And then what happens when you get to probable? When you get to probable, it's more likely than not that you are going to owe somebody something as a result. I can't talk. It's more likely than not you're going to owe somebody something as a result of something that's already taken place in the past. When you're at remote, there's little likelihood you owe somebody something. You have to do nothing in the accounting records because it's not likely that you're going to owe them. If it's reasonably possible, you need to make a note in the financial statements discussing the issue, but you got to be careful. You don't want to claim that you do owe it. Could be used in a lawsuit against you. I've seen it happen. So you make a note in the financial statements where you write in narrative that there's a problem, what it is, and how much you might owe, but that it's not likely that you're going to. Then you hit probable, the big probable. It's more likely than not. If something is probable, and if you can estimate how much it is, then you must actually record this event with a journal entry in the financial statements. Egads, like literally set up some kind of expense or loss and show that you have a liability, and you need to mention it in the notes as well, discuss what it is. And again, be careful. It can be used against you in a court of law, so it actually leads, when you hit probable and estimatable, to a journal entry, dropping net income and setting up the liability at the period. So here I'm going to give you some facts of a problem that has to do with a warranty, because warranties are perfect examples of contingency. You warrant a product against defects, and you know from the past that certain amounts are going to have defects, and you're going to have to make good on these. As soon as you make that promise, you have created the contingency. And since you're all the way to probable and you can't estimate it, you must actually make a journal entry. Let me give you some facts on a problem, and let's see how we do. My little facts: I'm going to have a company that sells computers, and they offer a 1-year warranty on the computers. Past history shows that warranty expense runs 8% of sales, and it's probable in amount. And I'm going to add the little caveat that during the course of the current year, you've already paid $1,000 of those warranty expenses. I want to run some entries with you. First, I would like to record the sale. And then in the same period, I'd like to do an entry to record the warranty expense. As a matter of good matching, and then I'd like to pay the $1,000 that we say you've already paid. In that order, because I think it will make more sense to you. But I tell you up front, it doesn't matter when you record the warranty liability and when you pay the expense. You still make the same journal entries, and as long as they're all made in the same accounting period, everything will come out perfect. So, first let's record our sales. Let's say they were on account or cash, it doesn't matter, and you record sales, $100,000. Much like you will record cost of goods sold and inventory when you record the sales, you would record the warranty liability. 100,000 times 8% would be 8,000, and you would debit warranty liability and warranty expense. I understand that you haven't paid it yet, but I understand that it's a result of those sales. It is probable that you will, and that it creates a liability in the same period that those sales are recorded. Good matching, yes? So this is a good matching entry, much like cost of goods sold runs with a sale for good matching. So you record the sale, and you record the liability, then you actually, let's say you paid, I don't want to use the word there, you paid $1,000 worth of the warranties during the period. Whether or not you've made the warranty liability entry yet, though you should when you record sales, you usually make that at the end of a period. During the period you pay some, you know that entry will be made, so you come out of the warranty liability account always, and if let's say it's a cash warranty, you pay the amount out in cash, so it could be inventory. So this records the liability, and this records when you actually paid the expense. This records when you record the sale. You record the sale, the period it happens. You record the liability. In the same period you record the sale as good matching. Whenever the warranty is paid, that's more what I meant to say, you make the following entry: debit warranty liability account and credit cash. And as long as all of these entries are made in the same period, the accounting will come out beautifully. Let's just pulse these entries and see what happens. We've recorded the sales. I really only want to look at the warranty expense and the warranty liability accounts. That's what I'm interested in. With your journal entry to record the liability, you debit the expense, $8,000, and you credit the liability. It isn't an exact amount at this point. It's an estimate. It's a contingency. You believe, based on past experience, it's probable that you will owe 8% of your sales in warranty costs. So you've currently reflected that in your accounting records. Then, whenever somebody brings in a computer and you have to make good on your warranty, that comes out of the liability account because you have already accrued the expense. When we get to the end of the accounting period, the warranty is $8,000, the warranty expense, exactly 8% of sales, which is what we said it should be. And we show we owe a further $7,000 in warranty liability on the balance sheet, the amount that we expect to still owe in the upcoming period. And it's current because the warranty was only for a year. So, in this pencast, you join me to learn about contingencies. We learned about remote, possible, and probable, and then we extended that situation to warranties, and we learned how to do the accounting for warranties. We record revenue, and in the same period, we match the expense and liability, and then finally, whenever a warranty is paid, it always comes out of the liability account in cash. You would never hit warranty expense again. You have already done that when you accrued the expense to start with. Wonderful talking to you. We're down to our last pencast. We're going to ace the final. Are you ready? Let's end this one and get going on the next.